Alright folks, welcome back. This week's performance was a bit better than the benchmarks. A percentage gain, and they were pretty much flat, the three benchmarks. But you know, I'm still a few percentage behind them since the beginning of my accounting year. If we look here, since the 6th of October, I'm 1.3% up, and the three life strategy funds are 2.6, 3.36, and 4.1. You know, so I've got a bit of catching up to do, basically, for this year. And we're only 6 weeks in, and I'm already a few percentage points behind them, so not good. Yeah, you can see the numbers there. Worst performance were Henderson Far East Income and Biotech Growth, and then the Fundsmith. Texas Instruments did quite well. Texas Roadhouse did quite well. Texas is winning by the looks of it. That's just for the record, I guess. And then here we've got the dividends. They're showing on the screen there anyway in the screenshots. But yeah, big bumper week for the dividends. Lots of big payments came at the end of the month. They tend to come in phases like that. When's the next phase, I guess? I wonder. Yeah, so December is a pretty average month for December. January, I think, is a low month for January normally. These are all quite small ones. Yeah, pretty low for January, 587. And then February's a low one again. I know, quite a high one actually. Incidentally, I've changed the way I'm estimating I'm kind of projecting this year's dividend. I'm just adding up. This is kind of the pessimistic estimate of the dividend here. So basically, it adds up what's been paid already, because that's money in the bank, and then it adds up this column over here, all the way down to the year end, which is in October. And this column has the pessimistic overlay, which I have happening here. So these numbers, they're multiplied by a decimal as like a pessimistic. You know, that dividend could easily get cut, or I could choose to sell it and buy something that's lower yielding. But I'll try and beat this reduced yield rather than the actual yield that will get paid if I hold on to it. So yeah, that's the pessimistic way of estimating my year's dividend. And obviously as they come in, this number will rise because, for instance, the next one that's pessimistic is this one. So on the 30th of December, I'll get that much instead of that much. So this number will go up more than that number gets taken out. Yeah, and then this is the optimistic version, which is the same, but it's adding up the column which has the full amounts in. Okay, and we had some transactions on Monday. So basically I sold Schroeder Real Estate Investment Trust. I sold. I think it was about a 20% gain. If we look here, that's where I was before. Yeah, 19.61% was my profit in it. So it's done well for a while. And there was this other property company that I was interested in. I think Merchants Trust holds it, and then there was this one other income invest portfolio manager who mentioned it in another podcast, saying that they owned it as well. So you know, it's the usual story. I don't decide for myself. I basically just copy other people. But it was at such a better valuation. They invest in healthcare property. So if we look here, where are they? Assura. We build for health is their tagline. We develop, invest in and manage a portfolio of healthcare buildings across the UK. So yeah, there's some little pictures here of the stuff they do. An ambulance hub. What is an ambulance hub? It's an hour later. I googled it. I still don't really know. They do various things. As far as I can tell, they just help with the logistics of hospitals. Nuffield Woking. I think they run GPs, don't they? I think my GP in my hometown, quote unquote, where I officially live, that's a Nuffield run GP surgery. I think they're a non-profit. But yeah, anyway, a lot of it is rented to NHS, and then GP surgeries like that one there, I'm guessing, looks like a GP surgery. And one of the things they said in one of the presentations was that they've kind of slowed down their building process because the cost of developing these properties has gone higher. and so they really need the NHS and other tenants to pay more money for it to be worth them spending the money on developing these properties. So my guess is that that could be part of why the share price has gone down and why the yield has gone so high. You can see the chart there. But yeah, anyway, the yield got to like 2 percentage points higher. I think I can't remember what the yields were, but basically the difference between the Schroeder real estate yield and the Assura yield was over 2 percentage points. And that difference was just too much. I have no doubt whatsoever that the dividend for Schroeder real estate will increase faster. But I just thought with that massive difference, because that's like this is just a rough number off the top of my head. If it went from a 6, it went to an 8.6, no, maybe lower. Let's go 8.5 divided by, let's go 6.5. The dividend for Schroeder real estate would have to go up by 30% to pay me the same dividend as Assura. So I just figured that difference was too high, so I just went for the switch. And in doing so, I took some of the profits from the switch and I put it into the SCHD portfolio, the pie, sorry. So we can see there the pie has grown to just over £1,000 now. So this is what I mentioned doing earlier, just each time I make a move in this section of the portfolio, I'll just put some of the profits into SCHD. So I mean, they have said that their dividend, the dividend of Assura in the next few years, they told us it's not going to grow as fast as it had over the past 5 to 10 years. So that low expectation is built into my thinking anyway. And I've kept the usual property 70% overlay for pessimism. And doing that accounting for cuts in the dividends of the property too, we can see that my expected income is 36% higher. Sorry, £36 higher, based on the moves I made on Monday. For some reason, they didn't like the interim report for Schroeder Real Estate, which I think was released the day after I did my switch. So that was released, and they linked this PDF. That's why it's a PDF instead of the ERNS that I normally go to. But anyway, I don't know. There's not much to say. The important thing that happened here was they actually raised the dividend by 3%. So their dividend payment now is 0.879p a quarter. That's why this differential here is already quite a bit lower than the 2% I was talking about. So if we do that minus that, you might have wondered why that number was smaller than I was talking about. And also, Assura has done better over the past few days anyway as well, so that would reduce it. So yeah, I mean, I wouldn't be surprised if at some point I just switch straight back again. I'm thinking to myself, if at some point this differential goes back to like 1% maybe, so I mean, we're not far off, are we? Actually, no. If it went back without the increase, so if we went back to how it was before, because I did these calculations based on this quarterly dividend, 853. So if we went back to how it was before, 853, it's already gone from a 2% differential to a 1.78% differential. So what if we multiply that by 1.1? I don't know. If something like that happened, maybe I'll just switch straight back. Even though it would be reducing my income, who knows what I might do. And then what was the next? Oh yeah, we had an update from Harmony Energy. Pretty similar to the Next Energy Solar Fund update that happened last week. The NAV's gone down. I mean, this update was on Friday, so it seems like Hargreaves Lansdown haven't had time to update their charts yet. But the NAV has basically gone to about here, where the pointer is there. So yeah, just another reduction, continuation of the downward trend. But I mean, this update happened on Friday, and as we can see here, the change on the day Friday was 6.38%. So the market seemed to like it, and I think I don't see why they would like it though, because I mean, this isn't that important. What's important with this one is the asset sale process. They're trying to sell the whole portfolio. But what confuses me a little bit is that they've said here that the schedule for that sale of the portfolio is going to be a month longer. So I don't quite understand why that's good news. They said it's because of the due diligence of the parties who are looking to buy the parts of or the whole portfolio. They haven't really said too much, but the due diligence is going to be detailed and it'll take longer. I mean, to me, that's, I don't know, is that good news or bad news? The fact that the due diligence is going to take longer. I don't know, but yeah, the market seem to like it, so I don't know. Maybe something's happening there that I don't understand. I don't know. Anyway, so that's that. Who knows? Yeah, they said by January the deal should be done. They reckon. What did they say? It says here the intention would be to enter exclusively with a preferred bidder in December and sign a binding agreement in January 2025. So I'm in 6% up in this one, which is pretty good. That's quite a coincidence that I must have been exactly flat on Thursday night for Friday's move to be exactly my profit in the company. Anyway, that's that one. And let's just cover this quickly. Another little insight into my life while I'm travelling around is this little spreadsheet I use. So at the moment I'm in North Macedonia. When I arrived here, I took about 200 quid's worth of cash out of an ATM. I hardly spent any of it because everything's pretty much everything's card here, which is the cheaper way for me to pay for things because I get 1% cash back and I don't have to pay the ATM fees. So by the end of my time in a country, when I do that, I have to get rid of my cash. So this is me tracking my cash levels going down. I need to make sure that I don't spend too much or too little because I don't want to be, because you know there are the occasional things that require cash, but most things I can pay for with cards. So I don't want to leave myself too little cash, but I also don't want to leave myself too much cash so that I can't spend it by the time I leave the country. So this is the little spreadsheet I've made where I just input what I've spent each day in cash. And I need to update that today. I almost left it too late. I realised on the 23rd of November that I've only got a few weeks left. I almost left it so that I was going to be left with too much cash. And then that cell there tells me the average amount each day I need to spend in dinars. Dinars, I don't know how you say it, which translates to £6.13 a day. So yeah. Basically, all of these days I've been spending everything in cash because at the beginning, that's about how much I've been spending each day. So if I hadn't realised that I needed to start spending in cash, I could have ended up with a load of cash in my pocket. Anyway, that's that. I don't know why I thought you might want to know about that. Oh yes, and I had a question in the comments. I just thought it would be easier to answer this question on the screen instead of just typing it, because it's just a load of data really. They just mentioned like trusts, dividend growth compared to inflation. Obviously, in that previous video, I went through how my portfolio has done and compared that to inflation. But in terms of the individual trusts themselves, I think they mentioned there was an article saying that they hadn't kept up with inflation, and my response was, well, yeah, would you expect it? When inflation goes to 11.58% and then 9.69%, I would never expect my trusts to keep up in those years. What I would expect them to do, though, is keep up in these years. So just to give a bit of perspective, I've had this spreadsheet, I've maintained this for years. I can't remember when I started exactly, but I've probably shown it before on the screen. But if we just... because apparently there was an article from an Interactive, I forget who they said, but apparently there was an article bemoaning the fact that investment trusts weren't keeping up with inflation. And to me, it's just so... It's people who just don't understand that you can't expect the world. You know, you can't expect, when there's 10% inflation, what the hell do you expect? We've got here RPI, we've got CPI, and we've got CPIH. But anyway, actually, let's go with the worst case scenario, because RPI is the highest one, isn't it, in recent years? So let's just go with that. And I've got a load of data here for some trusts I own, some trusts I don't. I've got a load of data. So if we start off, basically they're asking about individual trusts. But yeah, basically what I've done here is I've done RPI. I've done it from 2005. That's because at some point I've updated this spreadsheet and I've put in a cumulative number from 2005. I have no idea why I chose 2005. I mean, to be fair, the RPI seems pretty low before it. It's not like it's a cherry-picked date, is it? Because the RPI before it's pretty low compared to after it, apart from that year. But anyway, these are the numbers I've got in my spreadsheet somewhat randomly. And as we can see here, I've also done from 21 to 23 the cumulative inflation, because that is kind of comparing those two numbers is like the worst case scenario. It's going from just before inflation went really high to the latest data we have. So yeah, what we've got here is we've got a reasonably long-term measure of inflation, and we've got a very short-term worst case scenario measure of inflation. And I mean, it makes sense that the short-term 22 is going to absolutely trounce any increase in City of London, which is only 5.24. So yeah, massive difference. Over 15%. It hasn't caught up. And then Lowland, yeah, all these are really low compared to the inflation of 22% over those years. But then, we get to one that's not done too badly. BlackRock Smaller Companies is only a couple of percent behind. Finsbury Growth, I don't own that anymore, but I've got data from when I did own it. Yeah, that's lagging. HFL, heavily lagging. Murray International, heavily lagging. Henderson International is only about 4 percentage points behind. It's because of that year, really. They had a big change in the policy, really. Let's get rid of these two, because these two are incomplete years. Let's hide those rows. There we go. That's better. So Henderson International hasn't done badly, and obviously Merchants very low. Scottish American done better, but again, not. Well, you can see the numbers yourself. None of them have beaten inflation, but I just don't see why people think they should expect that. What I've got here is my spending over the years as well. Because the thing is, each individual year doesn't have to be. You don't have to beat inflation each individual year, because each individual year your spending doesn't increase by inflation. You have lumpiness to your spending. Because if we look at my spending here since 2017-18, it's gone from 16,500, 15,000, 14,000, 12,000, 12,500, 12,000, 11,000. I'm planning on 12,500 this year. So as you can see, my spending hasn't gone up with inflation. And what's probably going to happen with my spending is, and as we can see here, some of this is accounting for money that I spent in, when was it? March 22, year 7. So I think it's accounting for a car I bought in, I think, looking at that, it's year 7 in 2022. So what, 2016, maybe 4, 5, 6, maybe 2015. So this spending, 986, is all money that I spent 7 years ago, according to that. So spending is lumpy, and it doesn't necessarily go up every year. Because all I need to happen is that in longer periods like this, what is that, 2005, that's 18 years, isn't it? So over 18 years, RPI has gone up by 94%. And if we go through the numbers for some of these trusts, City of London's beaten it by about 40 percentage points, I think. The FTSE 100 hasn't beaten it, so that's one of the reasons I like trusts. FTSE 250 has trounced it, but then there's lots of volatility here, like down 30%, down 5, down 20% there, but overall it's trounced RPI in terms of the dividend payments. Lowland has absolutely trounced it in that 18-year period, 242% higher rather than 94% higher. BlackRock Smaller Companies, look at that, 784% higher over the longer term. Finsbury's done similar to City of London, beating it by over 40%. Henderson Far East Income has as well, but I doubt that's going to come back to times like that. Yeah, these. I think something happened. I wouldn't trust that number, to be honest. These numbers seem very erratic. It's almost like the trust got took over and like the whole philosophy changed. Maybe it went from a growth fund to a income fund or something. Yeah, I wouldn't trust that number, to be honest. Murray International. I mean, something might have happened here as well. I don't know, but where's the data? We don't seem to have data here. Why not? Oh yeah, because we don't have 2005's info, do we? That's why. Yeah, I don't know what the number is for that. And then Hint didn't exist at that time. But I mean, Hint's doing pretty well anyway in this worst case time frame. Yeah, Merchant hasn't done well. Yeah, so that's the only one that's failed over the longer term, I think. Apart from, well, yeah, the FTSE 100 itself. Yeah, Scottish American is beating it by about 20%. Witten is beating it by a lot more. I've never owned Witten. I put it there when I was considering buying it. But yeah, but I mean, yeah, these ones aren't a fair comparison anyway because these are much lower yield as these two. So you would expect the dividends of those to grow. They need to because they're not offering much income to start with. So yeah, that's not a fair comparison really. But yeah, those. But I mean, they're part of the portfolio anyway, you know. So the growth in these lower yielders, because I do own Brunner, BUT. I do have lower yielders, which you would expect over the long term to grow the dividends more because they've got more growth potential in them. So they are part of the portfolio, you know. It's not just all high yielders. What's JC? Oh yeah, that's JP Morgan Claverhouse, isn't it? So that's similar to City of London. So yeah, 200%, absolutely trounced inflation. And then FSIT is another very growthy one with a low yield. So that doesn't really count. Same with Jam. That's a really low yielder. Doesn't really count. But yeah, as you can see, the point I'd make is don't expect it to beat inflation every year. That's just unrealistic. All you should care about is the long term. So that's why I've got this being monitored. I'm going to monitor now each year how long it takes for each of these holdings to catch up. When I've got 2024's full data, I'll update all of these numbers and I'll change the formula and I'll make that 21 to 24 so we can see how long it takes for us to catch up in the whole period, you know, from the start of the high inflation. Oh, and I forgot to tell you the other transaction I made. So I just bought another couple of grand of the ERNS short-term bond ETF. Basically, it's like a money market fund. So yeah, put another couple of quid in, a couple of thousand in, because I've got more cash in there now. Because was it last week, the week before? Anyway, recently I sold something and I bought most of the proceeds. I bought inside tax wrappers, so I've got a load more cash now that went into the Trading 212 general investment account. And this week they announced that the interest rate was going to go down to 4.9%. So it kind of just prompted me to put a couple more grand into the money market fund, which should hopefully do a little bit better than 4.9%. All right, I don't think there's anything else to say really. We are all done. See you next week. If you've got any questions, because I might start running out of things to talk about in these videos, so it's quite handy to have questions like that in the comments that I can add to my weekly video. All right, cool. I'll see you next week then. Bye. Bye.